There's a tax you pay every single year that doesn't appear on any form, doesn't get debated in Congress, doesn't require a vote, and costs the average American more than income tax, property tax, and sales tax combined. And the institution collecting this tax is the Federal Reserve. And the mechanism is so elegant, so hidden in plain sight, so protected by layers of economic jargon that most people pay it their entire lives without ever realizing they're being robbed. This isn't conspiracy theory, this isn't speculation. This is documented policy, openly discussed in Federal Reserve meeting minutes, explicitly targeted in their mandate, defended by economists as necessary and beneficial, and I'm going to show you exactly how it works, down to the mathematical precision, down to the dollar amounts, down to the specific mechanisms they use to transfer wealth from your pocket into the financial system. And once you see it, once you understand the machinery, you'll realize that almost everything you've been taught about money, about savings, about building wealth, has been designed to keep you blind to the theft happening right in front of you. Let me start with a simple question, and I want you to really think about this before you answer. If you put $10,000 in a savings account today, earning the national average interest rate of about 0.4%, and you leave it there for 10 years, how much money do you have at the end? Most people would say you have $10,400, give or take, because that's what the bank statement will show. But here's what they don't tell you. Here's the part that changes everything. That $10,400 in nominal terms is worth about $7,000 in today's purchasing power, which means you didn't make $400, you lost $3,000, you lost 30% of your wealth by doing exactly what you were told to do, by being responsible, by saving, by trusting the system, and the entity that took that $3,000 from you was the Federal Reserve. And the mechanism they used was inflation. And inflation isn't some natural economic phenomenon like the weather. It's a policy choice, a deliberate tool, and the people wielding it know exactly what they're doing. The Federal Reserve has an explicit inflation target of 2% per year. They state this openly. They defend it publicly. They claim it's necessary for economic growth and stability. And 2% sounds small, sounds manageable, sounds like barely anything worth worrying about. But let me show you what 2% actually means when you run the numbers. Because 2% annual inflation means that money loses half its value every 36 years, which means that if you're 40 years old today and you retire at 70, the money you've saved will buy half as much when you need it, and if you live to 90, it'll buy 1/4 as much. And this isn't theoretical, this is mathematical certainty. This is what 2% compounded annually does to purchasing power, and the Federal Reserve knows this. They're not stupid. They're extremely sophisticated. They employ hundreds of PhD economists who understand these calculations better than anyone, so when they target 2% inflation, they're explicitly choosing to cut your purchasing power in half over the course of your working life. But here's where it gets worse, because 2% is the target, not the reality, and the way they measure inflation is designed to understate the actual loss of purchasing power that ordinary people experience, because the Consumer Price Index, the CPI, which is the official measure of inflation, has been modified repeatedly over the decades to show lower numbers, and these modifications aren't conspiracy theories, they're documented changes in methodology, changes like substitution, which assumes that if beef gets expensive, you'll just buy chicken instead. So the price increase doesn't count as inflation or hedonic adjustment, which assumes that if a computer is twice as fast, it's worth twice as much. So even if the price stays the same, that counts as deflation. And these adjustments make sense in an academic economic model, but they don't reflect the reality of what things actually cost, because you can't substitute your way out of housing costs. You can't hedonically adjust your rent. You can't use methodology to pay for healthcare or education or food. If you look at the things that matter most, the things that consume the largest portion of household budgets, housing, healthcare, education, the real inflation rate is much higher than 2%. It's closer to 6 or 8 or 10% depending on where you live and what you need to buy. And this means that the Federal Reserve isn't just targeting 2% erosion of your purchasing power, they're enabling 8 or 10% in the areas that matter most. And this is the hidden tax. This is the mechanism of theft, because every year the things you need to survive cost more, but the dollars you've saved buy less. And the gap between those two things is wealth that's being transferred from you to someone else, and that someone else is always the people who get access to newly created money first. which is banks, financial institutions, asset holders, the people who are already wealthy. Now let me explain the mechanism in detail, because understanding how this works is the key to seeing through the lies they tell to justify it. And the mechanism starts with how money gets created in the modern system, because most people think that money is created by the government printing physical bills. But that's only a tiny fraction. The vast majority of money is created by banks through lending, and the Federal Reserve enables this by controlling the money supply and interest rates. And when the Fed wants to stimulate the economy, which is almost always, they lower interest rates and create new money to buy government bonds and other assets, a process called quantitative easing. And this new money enters the financial system first. It goes to banks and financial institutions, and those institutions use it to buy stocks and bonds and real estate, which drives up the prices of those assets before the new money ever reaches ordinary workers through wages or employment. This is called the Cantillon effect, named after an 18th century economist who observed that when new money enters an economy, the people who get it first benefit at the expense of the people who get it last, because the early recipients can buy assets at old prices, while later recipients face higher prices but haven't received the new money yet. And this creates a systematic transfer of wealth from wage earners to asset owners, from savers to borrowers, from the poor and middle class to the wealthy. And this isn't a bug in the system. This is how the system is designed to work, because the Federal Reserve was created by bankers to serve banking interests. And while they talk about dual mandates of price stability and maximum employment, their actual function is to ensure that the financial system remains liquid and profitable. And if that requires sacrificing the purchasing power of ordinary savers, well, that's just the cost of doing business. If this is making your blood boil, if you're starting to see how the game is rigged against anyone who works for a living instead of living off assets, then you're beginning to understand. And if you found this valuable, hit that like button right now, because the algorithm needs to know this information matters, and more people need to see this. And if you're not subscribed, subscribe immediately, because what comes next is going to show you exactly how much this costs you personally, and the number is going to shock you. Let me put some real numbers to this so you can see the scale of the theft, because abstract percentages don't convey the human cost, but concrete dollar amounts do. So let's say you're a typical American worker, you make $60,000 a year, which is close to the median household income, and you're trying to be responsible. You're trying to save for retirement, so you put away 10% of your income every year, which is $6,000, and you do this for 30 years. And at the end, you have about $300,000. In nominal terms, assuming modest investment returns that roughly match inflation, and that sounds like a lot of money. That sounds like you did everything right. But here's what they don't tell you. If inflation averaged just 3% over those 30 years, which is actually conservative given real-world costs, that $300,000 has the purchasing power of about $125,000 in today's money, which means you lost $175,000 to inflation. You lost more than half your savings to a hidden tax that nobody voted for, that appears on no budget, that gets debated in no election. Now think about what you could have done with that $175,000. Think about the security it would have provided, the opportunities it would have created, the stress it would have eliminated, and then ask yourself where that money went, who benefited from your loss, because wealth doesn't just disappear. It gets transferred, and in this case it got transferred to the people who hold debt denominated in dollars, which means the government, which has $35 trillion in debt that gets easier to repay as the currency loses value, and it got transferred to the banks that create money through lending, and it got transferred to the asset holders who saw their stocks and real estate appreciate faster than inflation while your wages struggled to keep pace. And this is the mechanism. This is how the Federal Reserve legally steals 10% of your wealth every year, not through direct confiscation, but through the slow, steady debasement of the currency that forces you to run faster just to stay in place. But the theft goes deeper than just inflation, because the Federal Reserve also manipulates interest rates in ways that systematically favor borrowers over savers. And this sounds technical, but the implications are profound, because for most of human history, savers received a positive real return on their money, meaning that if you saved diligently, your purchasing power increased over time. You were rewarded for deferring consumption, for being prudent, for providing capital that could be invested in productive enterprises. But in the modern Federal Reserve System, real interest rates are often negative, which means that the interest you earn on savings is less than the rate of inflation, which means you're being punished for saving. You're losing purchasing power by being responsible. And this isn't accidental. This is explicit policy because the Federal Reserve believes that consumption drives growth, that saving is bad for the economy, that people need to be incentivized to spend rather than save, so they deliberately keep interest rates below inflation to force this behavior. Think about what this does to society. Think about the incentives it creates. Because when saving is punished and borrowing is rewarded, when prudence costs you, money and debt is subsidized, you create a culture of immediate gratification, of living beyond your means, of assuming that tomorrow's problems can be solved with tomorrow's money, and this benefits the financial system enormously, because a population in debt is a population that's controllable, that's dependent, that can't afford to take risks or challenge authority, and this is why student loan debt has exploded to over $1 trillion, why credit card debt exceeds $1 trillion, why auto loans exceed $1.5 trillion, why mortgage debt exceeds $12 trillion, because the system is designed to push people into debt, to make debt seem normal and necessary and inevitable, and debt is how you get controlled, because people in debt work harder, complain less, take fewer risks, stay in jobs they hate, accept conditions they shouldn't accept, all because they need the steady income to service the debt that the system encouraged them to take on in the first place. Now let me show you something that will make this even clearer, because we can actually quantify the wealth transfer that happens through Federal Reserve policy, and economists have done this, they've calculated it, and the numbers are staggering, because between 2008 and 2020, the Federal Reserve created roughly $4.5 trillion through quantitative easing, and this money went primarily to purchasing government bonds and mortgage-backed securities, which means it went to banks and financial institutions, and the effect of this money creation was to inflate asset prices. Stocks went up, real estate went up, bond prices went up, and the people who owned these assets got wealthier, much wealthier. The top 1% of Americans saw their wealth increase by over $20 trillion during this period, while the bottom 50% saw essentially no change in their wealth. And this wasn't because the rich worked harder or created more value. It was because they owned assets that appreciated due to Federal Reserve policy, while ordinary workers saw their wages stagnate and their savings eroded by inflation. This is theft. This is systematic wealth transfer from the many to the few, and it's legal because the people who benefit from it are the same people who write the laws and regulations, the same people who staff the Federal Reserve and the Treasury Department, the same people who fund political campaigns and think tanks and academic institutions, and they've created a system so complex, so technical, so wrapped in economic jargon that most people don't understand it, and the people who do understand it benefit from it, so they have no incentive to explain it, and the people who could explain it in simple terms get marginalized as conspiracy theorists or economic illiterates, so the system perpetuates itself, generation after generation, crisis after crisis, always extracting wealth from the bottom and middle and concentrating it at the top. But here's what gives me hope. Here's why I make these videos despite the depressing nature of the subject matter. Because the system only works if people don't understand it. It only functions if the theft remains hidden, if the mechanisms stay obscure, if ordinary people keep trusting that the Federal Reserve is working in their interest rather than against it. And every person who watches this video, who understands these concepts, who sees through the propaganda and the jargon, is one more person who can't be fooled, one more person who makes different choices, one more person who builds resilience outside the system. And if enough people do this, if enough people stop playing the game by rules designed to ensure they lose, then the system has to change, because it depends on your participation, your trust, your willingness to hold dollars that are being debased, to save in accounts that pay negative real returns, to accept that this is just how things are and nothing can be done about it. Something can be done about it. You can opt out, partially at least. You can hold assets that the Federal Reserve can't inflate away. You can understand that cash is trash in an inflationary environment, that bonds are a guaranteed loss when real interest rates are negative, that the only way to preserve purchasing power is to own real things, productive assets, scarce assets, things that can't be printed, and yes, this means taking more risk than putting money in a savings account. And yes, this means educating yourself about investing and asset allocation. And yes, this requires effort and thought and willingness to challenge everything you've been taught about money. But the alternative is watching 10% of your wealth disappear every year, while the people who took it tell you it's for your own good. I want you to think about your own situation. I want you to calculate how much this has cost you. Personally, take your savings. Take the number of years you've been working. Apply a conservative estimate of real inflation minus the interest you earned and see what you come up with. And then ask yourself whether you're angry enough to change your behavior, whether you're motivated enough to learn how to protect yourself, whether you're willing to accept short-term inconvenience to achieve long-term security. And I want you to leave a comment telling me that number, telling me how much the Federal Reserve has stolen from you over your lifetime. Because seeing these numbers, seeing real people calculating real losses, that's what makes this abstract policy concrete. That's what transforms statistics into human stories, and human stories are what drive change. And if you think this is bad, if you think a 10% annual theft is the worst it gets, then you need to understand that this is just the baseline. This is business as usual. This is the steady state operation of a system that's designed to extract wealth from workers and transfer it to asset owners. But we're not in steady state right now. We're in the late stages of a debt supercycle. We're approaching the moment when the mathematics become impossible, when the debt can't be serviced even with artificially low interest rates, when the only options are default or hyperinflation, and when that moment comes, and it's coming sooner than most people think, the theft won't be 10% per year. It'll be 50% in a year, or 70% or 90%. And the people who haven't prepared, who haven't diversified, who haven't built resilience outside the dollar system, those are the people who will lose everything, just like the savers lost everything in Weimar Germany, just like they lost everything in Argentina, just like they lost everything in Venezuela, just like they've lost everything in every hyperinflationary collapse throughout history. The pattern is always the same. The government and central bank create too much debt. They monetize that debt by printing currency. They tell people everything is under control right up until the moment it isn't. And then the currency collapses and savings evaporate and the social order breaks down. And the people who saw it coming and prepared are the ones who survive with their wealth intact. And the people who trusted the authorities, who believed the reassurances, who thought it could never happen here, those are the people who end up destitute. And I don't want that to be you. I don't want you to be the person who looks back in 5 years or 10 years and says, I saw the warnings, but I didn't act. I understood the problem, but I didn't change my behavior. I knew the system was rigged, but I kept playing anyway. So here's what I want you to do. I want you to subscribe to this channel right now if you haven't already. I want you to turn on notifications so you see every video, because we're building something here. We're creating a community of people who understand how the system works and who are taking steps to protect themselves. And the next video is going to show you specific strategies for preserving wealth outside the Federal Reserve System, specific assets that maintain purchasing power during inflationary periods, specific tactics that the wealthy use to protect themselves from the theft that ordinary people suffer. And once you understand these strategies, once you implement them in your own life, you'll be in the 5% who survive the coming crisis with their wealth intact, instead of the 95% who lose everything. But before that video, before we talk about solutions, we need to complete the picture. We need to show you the master plan, the end game, the reason why everything we've discussed in this entire series has been building toward this moment. And that video is coming next. It's called The Final Transfer, How CBDCs Complete the Theft. And it's going to show you how digital currencies are the mechanism for accelerating this wealth transfer, from gradual to instant, from hidden to overt, from 10% per year to 100% overnight. And once you see how all these pieces fit together, once you understand that the inflation, the debt, the banking crises, the digital currencies, they're all part of one coordinated system designed to extract maximum wealth from ordinary people, you'll never see the financial world the same way again. So, I'll see you there.